Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Closure Show. As always, Scott Carson, excited to be with you today. Really excited for this episode. We're going to dive into something we don't talk that much about. I mean, we've talked about it in the past, is commercial real estate. And our special guest today it's funny, you see people who convert or leave jobs or change professions. And our special guest today, he is a retired pharmacist turned real estate investor with roughly, just about 1 million square feet in commercial real estate that he's got under management. He's also the author of a book you definitely want to check out called Value Over Volume, The Foundation of Commercial Real Estate. And it's a great book. We'll dive into that. I know a lot of folks have been asking about commercial real estate. We'll talk about distress markets right now, what's going on, and how this guy and his team are doing something I think that you guys will find valuable. So, out of Cincinnati, our friend Tanh Truong is joining us here today on the Note Closure Show. Tan, how's it going, man?
It's going well, brother. Thank you for having me on. You love your show. You're absolutely kicking ass over there, and you add a lot of value. So I'm excited to have this conversation with you today.
Well, thank you. You are doing the same thing too. I appreciate you having me on a couple weeks back. Looking forward to that episode coming out, and we'll make sure and link that in the show here to my interview in here. But before we dive in, I mean, your backstory, your evolution, your origin Marvel story, stuff like that. What attracted you to commercial real estate versus residential real estate once you left being a pharmacist?
Yeah, so like Scott mentioned, I practiced pharmacy for about roughly 3 years or so. I left New Year's Eve of 2020, and during my practice, even like during pharmacy school, I was actually learning about investments, learning about equities, just trying to figure out ways to get my money to work for me, and went down a couple rabbit holes with equities, stock investing, etc. And naturally that led me to real estate. And within real estate, I started small, with single family, small multis. I pretty much did the whole nine. I held, I wholesaled, I flipped, did a couple wraps, some sub twos, small things like that, but I've never bought a note, right? So I had a couple partners there. We started butting heads a little bit, and we decided to divest, just sell everything, split off, go our own ways. And luckily, it was an amicable breakup. And from there, I was kind of lost. I didn't know what the hell I wanted to do. Should I continue doing the same thing, or do I continue to look and scale bigger? So that naturally led me to commercial real estate because I was really just interested in the intricacies of it. It's one of those where I just don't know about it, so I want to know about it. And that just brought me down another rabbit hole of, YouTube University, getting on podcasts and just listening to all the experts that are out there. But again, that wasn't enough. Everything that I found was pretty rudimentary, and it didn't give me every aspect of it so that I felt comfortable to do it myself. Luckily, I found a mentor who's now my business partner, and we kind of ran from there. And to answer your question, Scott, what I like about it is that we're dealing with business owners. In residential, I'm sure your listeners yourself have a ton of horror stories, right? And in commercial, again, you're dealing with business owners. You don't really, you're going to have your fair share of horror stories, but they're, from my experience, not as bad. I love the aspect of talking to a business owner, partnering with them through the landlord-tenant relationship, and trying to figure out ways to either help their business or, helping them succeed in their tenancy in general. And I love learning about business too, right? Each different business has its own different nuances. So that's one aspect of it. Secondarily, I think with the coolness or the creativity of all the leases that you can do within the commercial space is very intriguing to me. And it helps the NOI a little bit and therefore gets your value on the back end or that general commercial asset to increase a little bit better.
Great stuff. The great stuff. Love it. Now, when you're talking commercial real estate and offices and stuff like that, what's your kind of your niche that if you talk about commercial estate, what's your favorite niche that you guys are targeting for the most part in today's market?
So for me, my bread and butter is retail and industrial. I think I navigate or I'm attracted to those assets a little bit more. Right now, however, I think office is presenting a really, really nice opportunity. ever since COVID, it kind of went down the shitter, and
Yep.
for 2 years or so, it was just getting beat down like crazy. You're seeing offices go for pennies on the dollar, tons of foreclosures, and just recently, it's starting to shift back to I wouldn't say back to normal, but it's on a tr upward trajectory. So, back then during the probably a year after COVID, during COVID, maybe even 2 years after COVID, you're probably seeing cap rates that are, 15, 20%. They're trying to get rid of these things, and sometimes they wouldn't even sell. Again, lots of foreclosures and whatnot, and now you're actually seeing some bounce back towards normalcy. And normalcy back in the day was probably you're probably seeing offices that were 80, 90% occupied, some at 100, but now you're still seeing offices that are, anywhere from 20 to 50% occupied, and in the better markets, some are close to 75, 80%.
Yeah, I mean, it's definitely we've seen our fair share of struggle here in Austin, Texas, with the office side of things. So what are and you're not investing all across the country. You've got some bread and butter markets that you like, that we can narrow down a little bit. The reason I asked that is we've got a ton of listeners out there that are coming across different tapes, different lists and stuff like that. So when I was on your show, I was like, "Hey man, we got to have you on your show because we could actually put some bird dogs in place here for you to find valuable stuff." So if you're listening to this and you're targeting asset managers, you're looking to get in commercial notes, and you don't know what the heck you're looking at, this episode is designed to hey, give you an opportunity, somebody who's taking advantage of the markets where I see some opportunity too, but also as potential stuff. So you're kind of in that Rust Belt area, like Midwest area where I think there's better value. It's not so many fluctuate. It hasn't been such a big fluctuation in a lot of cases. Is that right?
Yeah, yeah. So I'll look anywhere within the US. I typically avoid the coastal states. One, they're a little bit more expensive, and two, I don't have an advantage over the investors that are there. And the cap rates, you have to be boots on the ground to really find some really good deals out there. So for me, again, I don't have a competitive advantage to looking at deals that are in those areas. But outside of that, I'll look anywhere. But bread and butter from a market perspective is really the Midwest. You can really find a lot of opportunities here from a cost basis, and it hasn't appreciated as well as some of the larger markets. Like Cincinnati is a smaller metro compared to, Houston or Dallas and, California, LA, San Francisco, New York, things like that. So I try to look where other people are not looking, and I try to find places that are still not yet rampant when it comes to market prices and evolution. So again, Midwest is kind of where I'm sticking to right now, and that's where I still find a lot of opportunities.
hmm Now you're both looking at office, retail, and industrial a little bit.
Yes, sir.
Retail, that's made all the news of all these businesses closing and for lease signs and stuff like that. What's your plan with that? Is it also just going in and find maybe single or multi-tenant buildings that want to stick around for a while, or mismanagement? What are your kind of your I guess you say your parameters, your buy box that you look for?
So I'll preface this by saying, when you're looking at all the news that are coming out in retail, like there's a lot of shit that comes up, and a lot of it's clickbait, right?
Yep.
And a lot of these big boxes are going out of business. You got, what is it, J.C. Penney, Toys R Us, Macy's, Dillard's. Those big boxes are going out of business. I get it. That's scary. It definitely pushes you away from wanting to invest in retail. However, a lot of those news outlets are not highlighting the positives of retail. There's a lot of companies out there that are opening hundreds of stores, Aldi, Wawa, a couple other grocers and smaller companies out there are still expanding, opening up businesses across the country. So again, those are news that you don't see. And if you really look at the data, Marcus Millichap, they come out with great data. If you have CoStar, Crexi, you can kind of see some of those data in your local market. And retail is actually performing very well. And with the vacancies and occupancies that you're seeing in the area, it's slowly improving. It has improved, I should say. And honestly, I think the vacancy is at one of its lowest points ever. And that comes down to the brick and mortar stores. It comes down to how these businesses operate. I know people are scared of the Amazon effect and all that. But at the end of the day, if you really think about it, you can't really buy a pizza from Amazon. You know, you have to really buy it from a brick and mortar store. They deliver it to you, right? Or can you buy a haircut on Amazon? You really can't, you know, unless somehow they have people come straight to you and do the haircut in home. That might be a decent business model. But things like that, service-based businesses that still need that brick and mortar presence. And, you know, I talk to a lot of guys, and what they're seeing is that if they transition everything online, they're going to actually lose some market presence. So a lot of times you see regional centers or regional malls or whatnot, they have a brick and mortar there just to have their name brand shown to people, letting them know that they're still there. It's technically it's marketing, right? So to answer your question, I still think I see positive growth in retail. I think a lot of these businesses, no matter how many online conglomerates come up or how technology shifts everything, these businesses will find a way to adapt. And again, some of these other businesses that you see that are closing down, they did not adapt. And that is the repercussion, you know, closing down stores. I'm sure they still have an online presence, but I bet you some of their sales are decreasing pretty rapidly or you know extravagantly to the point where they can't have a store, right? That they just didn't adapt that well. Does that answer your question?
Totally answers my question on that too. It's like like Best Buy. We see that with Best Buy, kind of bringing in other things versus just appliance or electronics. I think that they're doing some like furniture here locally with one of the other bigger name brands, or them going to smaller like the cubicles, like the old red box cubicle stuff in the airport where you can buy electronics directly from them, or other places, or smaller stores in the malls to avoid that big overhead and all the utilities that go along with a big box brand. You know what I mean?
Right, right.
Now,
Yeah, I mean,
when you look at price, I'm a big believer that the biggest opportunity is that small balance commercial stuff like that, 5 million and below. Is that kind of where you're looking at for the most part? In what
yes,
cases?
my sweet spot, I'm looking at anything around 2 to 10 million. I'd say 2 to 8 million is kind of where the really sweet spot is. Anywhere in between there. As soon as you get over that $10 million mark, now you're playing with the heavy hitters, like
Yeah.
your big firms, BlackRock, etc. And they have pretty much more money than God, and they can just they're gonna buy you out, right?
They're just printing money there. I mean, at
Oh
1%, I mean, less than 1% what they're paying. Yeah,
yeah,
it's hard
yeah.
to compete. But they're so big, they don't want that smaller balance commercial stuff in a lot of cases, right?
Correct, correct. And they have the ability to buy cash. Like even if I jump into that space, maybe I can operate it a little bit better if it's local to me. But at the end of the day, you know, I typically underwrite with a commercial loan in place, and they're going to come in buy cash. And any owner, they're going to take a cash with better terms over someone like me who wants a little bit longer DD to get my ducks in a row and having to deal with the bank with all their third party reports and red tape and whatnot. So they're going to beat me probably 9.5 times out of 10.
Right. Well, but that's the thing is you carve out that niche. It's kind of like that movie War Dogs. You know what I mean? We live on the crumbs, you know what I mean, and
Yep.
make a good investment in the crumbs there for you out there. Now, you add kind of, brought up the next question I was going to ask you with the financing side of it. So you're raising capital, do syndications, are you taking over existing financing, getting some owner financing to create stuff done in a lot of your different projects?
Yeah, so historically, that was probably one of the biggest things that we had to do because prices were pretty high to the point where we couldn't really, you know, when we underwrite, we come in, I would like to have a cash flow from day one. And ideally, in a perfect world, it'd be somewhere around 10% cash on cash day one. And if I can add some value, that would jump it up to mid 20s, hopefully 30s. And obviously, you have your value on the back end. And a lot of times, the bank financing, as you guys know, like with all the rates that have increased in the past, it's really hard to do that. And you know, rates were at 7.5%, and you're getting cap rates at 7.5%. You're already neutral, right? And if you get a deal that's at a lower cap rate, you're already in the red. So your business plan has to be really intact. But in the past, we've done some seller financing. We've looked at assumable notes because if it's something that's in the favorable terms, that would help us cash flow a little bit better. Right now, we'll underwrite at the bank rates that are provided to us. We're looking at around six and a half now. And I don't know if you guys know, but the Feds have just cut 25 bips, and they're looking at cutting another 50 bips by the end of the year 2025. So might be a little bit more favorable in the future, but again, Now we underwrite around 6.5 for our interest rates. If we can get a better term with our sellers, if they're providing seller financing, or if we can assume a note at a better rate or better terms, perfect. Um, I love the aspect of seller financing because within that space, there's a lot of levers that you can pull. It's not just, a lot of people harp on just the terms or just the rate, I should say. But at the end of the day, you have a couple other levers you can pull when you're negotiating with the seller, i.e., 40-year AMs or even longer. You can go to a 100-year AM if you want, right?
Right.
Or you could do interest only for a certain amount of time. You could tier your payments to the seller, or you can do a reverse amortization. I love walkable notes as well. So you have to get really creative when times are tough, and those are the guys that will be able to construct a deal when times are difficult.
Yeah, when you got to motivate seller, they'll definitely get flexible in a couple of things. We always say, you can have your price, and then I'm going to have my terms. If you want your terms, I'm going to get a better price for it. There's a bit of a
100%.
negotiation. You know what I mean? And making sure the numbers make sense for you on that. When you say walkable note, what do you mean by that?
So you can structure a note with a seller to be able to take that loan and put it onto another asset of equal value or better, right? So at the end of the day, it's a really flexible note where you can kind of put it to another asset as collateral.
So kind of cross collateralize it then in a
Correct.
lot of cases. Okay, that's what you
Correct.
mean. Just basically cross
Correct.
collateralizing with different assets,
Yeah.
stuff like that. Okay,
So
cool.
for example, Scott, let's say you're the owner, you're the seller, I'm buying it from you. We get onto, let's say you're going to loan me $1 million. I pay you X amount of dollars per month. But I have a clause in there that is eligible to make it walkable. And the stipulation is that an it has to go to an asset that is of equal or better value. So I'm like, okay, I actually want to buy this asset now, and I'm gonna get another loan for this one in some way, shape, or form with your original property. But now I want to take your loan and put it on this property that I want to purchase. And let's say it's worth $3 million instead of, one or two. I can do that with a walkable note.
So it's, as long as it's the same seller, is what you're saying, or
Well, you're my bank.
yeah.
You're my bank, so I can take that loan from with you and take it to another property. And
Oh,
obviously,
okay.
yeah,
Very nice. I like that. So it's kind of like a 1031 exchange, but with the debt side of
with
it,
the
not
debt
the
side.
actual prop. Oh, okay. Yeah,
Yeah,
yeah, yeah. All right. Yeah. Just assigning it to a different asset in a lot of cases and keeping the
correct.
terms in place. That makes
Yeah.
sense. Now, with it being in commercial real estate and stuff like that, you're not having to proof up your FICO scores and stuff like that. It's more about experience and kind of what's going on in the actual cash flow of the asset, right?
Yeah, I mean, well, I'm sure the banks will check our credit score and whatnot, but generally they prioritize your experience before anything else. And obviously relationships, right? So we've been dealing with the same, we love community banks
Yeah.
and because they've bent over backwards for us and we've worked with the same one for, well, I have to say my partner because he has a lot more experience than I have, 15 years or so with the same bank. I've only been in for roughly 4 years and some change, so my relationship with them is still young.
Mhm.
But
Well, but the thing being said too, I love it. What you said, community banks have been hit the hardest because they're the ones that finance about 70% of this commercial debt
yeah,
since 2015. We can say when it's beforehand, it was Wall Street financing most of that debt.
right.
And community banks too, they don't have the ability to recover if something's going south pretty fast.
It'll be
That's
tougher.
yeah,
Yeah,
the Fed will step in and say, "Hey, your reserves have to go up." So bringing in somebody in that allows to allow. I mean, we even see that on the note side of business. We're buying a distressed note in commercial property. If it's over $1 million, that bank will often finance our note purchase because they don't want to lose that relationship.
love that.
And we only have to bring 10 to 20% down or zero, depending on how far upside down that asset is originally. So
Yeah, yeah.
where do you see are you deal with the same headaches when you're dealing with borrowers or tenants too? And I mean, not borrowers, you're the borrower, but with tenants sometimes struggling to get by on things. What are some of the workout things you've done as far as commercial leases and stuff like that? I'm sure you've had to modify it or work with a borrower in a lot of cases, like you said earlier on, depending on where they're at and what the story behind the story is, right?
Yeah, I mean, so fortunately, we haven't had a lot of tenants that really wanted to forbear or couldn't make couldn't pay their rents, right? But
Mhm.
there were a few, and in that circumstance, we try to make it a win-win for both parties, right? Okay, maybe you can't pay your entire rent, but what can you do?
Yeah.
What if I, what if we gave you a month or two of a pass and just kind of added on to the end of your term? Would that help you? Sometimes yes, sometimes no. Or what if we cut the rent in half? Or, what do you need? So a lot of times it's figuring out a problem. What obviously the problem is they can't make rent, but okay, what are our solutions? How can we help you overcome this little hurdle that we're running into? Those are two of the primary things that we've done in the past. And if at the end of the day they can't do that, we kind of have to part ways. And obviously that comes down to evictions if you have to go there and just breaking the lease, right? And we've also had other occurrences where tenants would just pretty much ghost us and bounce. And that's a pretty shitty situation. So one of my stories here, I had a flex-based building an hour north of Cincinnati. Got this deal off market, and it was a seller leaseback deal. So it's where the seller sold it to us. They leased out X amount of space for X amount or Y amount of terms, time, right? So the building was roughly 60% occupied. The previous seller took up 60% and signed a 5-year lease. The 40% was our upside. So we leased it out to a smaller mom and pop Amazon FBA type business. Paid rent for a couple months, did some improvement to the space, but then after that, just pretty much left without talking to us. Communication stopped and left the space as is, which was nice, but you know, you can't just break out a lease. Like, why wouldn't you communicate with your landlord? Like, what's going on
Right.
here, right? So in that case, and we were out roughly 50 grand in commissions for that deal. And so after a period of time, we filed with the court for, well, we didn't really file eviction because he's already out, but we filed
Mhm.
for collections, right? For a judgment. And I don't know, the
Right.
judgment was pretty much the term of his lease and everything that we've missed out on, commission included.
No.
The problem with that, so a lot of times in commercial, you want a personal guarantee. But what I've slowly found out is that personal guarantees are pretty much worth dog shit because the collections that you're going to go through with attorneys, it gets pricey, right? But the the likelihood of you actually collecting on a tenant or any person is very low. It's like less than 1%. Even if you're able to find like their bank account or if they had another business, you can put garnishes on it. If they had other properties, you can put a lien on it. But, you know, how, let's take that scenario. If they had a property, you put a lien on it, when are they going to sell it? So you could probably
Mhm.
sit on your hands for shit, a couple years, decades even before you even see anything. And now, if they don't have any other assets, what are you going to garnish? And if you are able to find their bank accounts, they can literally just drain that bank account the next day, and you're left with, again, nothing, right? Or the other alternative is the tenant or the person can just file for bankruptcy, and now you really got nothing, right? And you've gone through all the legal paperwork, costs, etc. So that's why your collection rate is so low. So lesson learned there would be, you would want to screen your tenants a little bit better, and we've done the background checks and whatnot. We've looked at their balance sheet and their history in business. So I don't know how much tighter you can get when you're evaluating a tenant, but I would try to figure that out for the next one. Um, and for that deal, the seller actually started slow paying us. It was one of those where their business was not generating enough profits, so they couldn't fulfill their rent obligations. So in that scenario, every they were paying half their rent for X amount of time.
Mhm.
And eventually, luckily, they got caught up, and so the rest is history on that one.
That's why I agree with you there. When I was a landlord, I wouldn't go after back rents or deficiencies. I just would 1099 them for the lost rents and any repairs I have to do because that made an immediate impact, on our, what we got taxed on, and then they had the burden of paying taxes on that the benefit, you know what I mean? And it made a bigger dent in our bottom line versus trying to chase somebody for 2 years. It's hard to chase.
Yeah,
If they're not in business and don't have a lot of resources, it's hard to beat a horse when it's down. You know what I mean?
yeah, yeah. So you W-9 them?
Yep.
Yeah, yeah, yeah.
Yep.
Okay, gotcha. So yeah,
Yep. repairs, you know, the rent for how many long if they leave, stuff like that, late fees too, anything else like that, some stuff like, if I have to repair the property, those costs go into it as well,
Got
you
it.
know.
I love that. Yeah, I haven't
Yeah,
tried
so
that, so that's a good trick there.
well, here we go. We're
Yeah.
learning something new every day here.
I love it.
Um, when you're looking at tenants, is there a kind of a red flag tenant? I think about when you said you got started, you've been doing this for 4.5 years now. A lot of restaurants are struggling and stuff like that. Is
Yeah.
there any, are there any specific things like, oh, if you're in, I mean, I know you mentioned servicing like haircuts, like great clips or even nail salons, that in-person stuff, but I know a lot of restaurants are struggling to get by and everything. I've got some friends in that restaurant space that are struggling too. So what's there some tenants that you're like, nah, we're not going to do that.
So the two of my least favorite tenants would be tattoo shops and karate studios, right?
Okay.
So tattoo shops, they have a diverse set of clientele that come there.
That's a very politically correct way of saying that. Diverse. Let's just say they have a rougher crowd. Let's just
Rougher
say a rougher
crowd,
crowd.
yeah. So a lot of times there's a lot of loitering, and that causes some issues with neighbors and whatnot. And sometimes depending on where they're at, whether it be if it's a single tenant property, maybe not so much. But I like multi-tenant stuff, so that causes a red eye or a problem with the neighbors as well as the image or the aesthetic of your property. So that's one that I try to avoid as best as I can. And the karate studios, I don't have anything against them. It's just depending on your space, the noise level can get pretty high. So if your neighbors, or let's say you had a dentist next door or some type of medical practitioner next door with all that noise, and if you can't insulate it correctly, it causes additional problems for your tenants. Um, those are my two least favorite types of tenants in retail, if you will. But as far as looking at your tenants, like, restaurants, I try to look at, again, we'll look at their balance sheet, we'll see how many years they've been in business and what their track record's like and what their profits are like, what are their margins like, how do they operate in general? Are their operations efficient? Are they in
Mhm.
tune, right? Bars are another one that are tough. You really have to dive deep into their business in order to see if they will succeed. Um, my partner, he's invested in a couple bars that really went south, but you would think that he would have learned his lesson, but he recently just partnered with another bar operator. But this bar operator, he had the balance sheet, he had the track record, he's opened a couple successful ones, and this new one just opened up probably 2 weeks, maybe a month ago, and it's been doing very, very well. And it's small things. It's not just, how you hire and how you manage your inventory or how you charge the patrons, right? It's more so a lot of it comes down to the flow as well. So, the bar is this long bar, and during busy times you have probably 4 to 6 bartenders,
Yeah.
but they never, so each side of the bar is almost identical, and there's ingress egress out of the bar on both sides. So they can go still tend to table or wait on tables and manage their stations without interfering with the other side. So that's one small thing when you look at operations and efficiency. And this guy has done very well, so I'm hoping it continues on that trend. But again, you really have to dig into their background, what they've done, and how they can efficiently make their margins in order to pay rent.
Somewhere in my head, I'm hearing Bar Rescue with Bob Taffert and
Right,
his diagrams of
right.
inflow and outflow on that for sure. As an
Oh,
ex-bartender, yeah, I definitely understand
yeah.
that. um, on the industrial spot, is that mostly warehouse space that you're looking at? Is there a specific size that you like with that? Are you talking like single tents for that, or see multiple tents as well with its flex space too?
Yeah, so and I like industrial because it's the out of the three major asset classes, it has the least amount of issues. I guess it's more simple, right? All you have is essentially a slab of concrete with four walls surrounding it. Sometimes they're not even climate controlled, so that takes out the HVAC equation out of that. You're not even responsible for the HVAC, right? So again, I like multi-tenant stuff. So if there are, generally I look for three tenants plus, but I've broken that rule a lot of times. But so my main rule of thumb with industrial is the clear height and the power capacity. Because in commercial, you really have to step in the shoes of a tenant to in order to see whether or not this building has potential. So in an industrial, who are you going to be marketing to in order to fill your space? What are the users? A lot of times logistics, food processors, um, big heavy machinery or suppliers or manufacturers, right? And what do they need? They need to be able to move in and out pretty easily with their machines, forklifts, etc. And then that's where the power capacity comes in. They're with these heavy machineries, they're going to need heavy power in order to operate the machines.
Okay.
So again, with the height, you need larger garage doors as well. So my rule of thumb is roughly if you have 10,000 square feet, you want about 12 feet of clear height. And for every, call it 5,000 square feet or so more of space, you'd want another foot of clear height. If you have something like the trend right now, you're seeing these older buildings, they're anywhere from 12 feet, 10 to 12 feet clear up to maybe about 16 or so. The the nice properties now, the Class A's, everything's being built in the 20s, 24s, up to even 40 feet clear heights. So
Wow.
those are really, really nice because you don't really have that obstruction of getting in and out of these properties. And everything's pretty much built in three phase now to comply with, all these machineries that these larger operators are going to be using. Um, Fire suppression is one thing, but all in all, if you really look at industrial from a 30,000 foot view, it's four walls, slab of concrete, maybe climate controlled. Um, and yeah, that's pretty much what everybody's looking for.
And I'd also imagine probably close locations to airports, railways, other things like that too, for the
Yeah.
most part. Yeah.
Yeah, sorry, I guess I forgot to mention that, but I really love industrial properties that are really close to highways.
Yeah.
Airports are a really big factor because because they strategically place themselves close to major highways. And so why do you want to be next to a major highway? Because a lot of times these companies are transporting a lot of material to their consumers, and consumer being another business, right? You don't want to be located somewhere rural where it takes you 30 minutes or an hour to get to a major highway and then you're on the highway to get to your next spot. So if you're closer to the highway, it decreases your travel time, and for that operator, it's going to decrease their costs, fuel, time, paying the drivers, etc. And, with that being said, um, being around those major ports is, again, super important, right? And you don't want to be anywhere too rural. You want to be somewhere close. And to piggyback off of that, again, if you're looking at these big operators, they're driving semis, right? So your asset has to be able to facilitate those semis, whether it be parking or dock doors, or if the semis are for some reason going into the building, your doors have to be large enough. A lot of times these semis are 48, 50 feet long, right? So you have to have enough sufficient dock doors to facilitate whatever's going on the transportation logistics route. And they have to be able to get in and out pretty easily as well. It's not a simple retail shop where, you're driving your sedan in there. These things need a big turn radius, right? So the space have to accommodate for that as well.
That's awesome. I love that. I love it. Now I have to ask you a question. What was you wrote the book last year and came out with what was the thought behind the book?
Man, I do not recommend anybody writing a book. It's like rubbing a cheese grater against your forehead for like 40, 50 hours a week. Dude, it is brutal. But, luckily I had accountability partners, and, we met weekly, and that's what really got me writing every single week for 40 plus hours a week, and to be able to get it done in a year. So my thought process behind it was that I always like to document what I'm doing and lessons learned, things like that, just so next time I have something to reference to. And I try to keep everything outside of my head. Like I don't have a good memory. I put everything on paper so I can refer back to it when I need to. So my again, when I first started in commercial, I was looking for everything that I could, and I couldn't really find anything. And again, I found my mentor lucky enough that I could learn from him, and he started a mastermind, and I learned from all the people there. But then again, I thought if somebody else was in my shoes, they would have to find a similar mastermind in order to learn all this information. And I already have a lot of this shit documented. Why not just, clean it up a little bit, put it into a book, and just throw it out there. Whoever wants to learn, there you go, you got it, right? So I'm trying to help the next person who was like me, who was struggling, in order to, have something, you know. So when I vomited for a year onto paper, it came out to like close, like from a book format, a 6 by 9 book, it was gonna be 900 pages.
Wow.
So I sat there, I'm like, who the hell is going to read 900 pages without falling asleep? Like, that's just, I wouldn't want to read that. So I decided to break it in three. And the first one, like Scott mentioned, it's called Value Over Volume Foundation of Commercial Real Estate. That one's about 300 pages. And I think that book alone will get you probably a good baseline, about 50% of the knowledge there. The other two volumes that I'm working on, hopefully will get you another 30 to 40% total. And I'm still learning too, so it's never going to get you to
Sure.
100%. And so the second book, I have this stupid ass idea of turning it into a fable. So I'm pretty much back at square one right now.
Well,
Uh,
I have to commend you because, looking at value over volume, you cover some really great things in there. You break down the different types of commercial real estate. You talk about leveraging bank financing, the third party reports, and then looking at leases. Commercial leases are some of the most valuable things that people just don't understand. They haven't done it before, right?
Yeah, I mean, it's completely different from the multifamily world, right? From a 30,000 foot view, multifamily versus non-residential commercial, they're very similar. You'll look at market drivers, dynamics, household income, those things within the location, right? In order to assess whether or not that property or asset is worthwhile in pursuing as an investment. But then outside of that, everything else is different. It's all about the lease and how you structure that lease with your tenants. And multifamily leases, you're probably looking at 5 pages, 10 pages at most. Whereas in a commercial lease, you're looking at 30 to 40 pages. And it's filled with a lot of obligations that the tenant has versus the landlord. For example, single net lease, double net, triple net leases, those effectively pushes a lot of the expenses towards the tenant. And now you pretty much have to read every line of a lease to figure out what the relationship is like. And so when we go into due diligence to buy properties, a lot of our time during the due diligence is reading these leases for small whatever gotchas that are in there. And attorney can review it too. And sometimes they miss shit.
Hmm.
So those are the main differences, right? Yeah. Did that answer your question?
Totally answered my question because you want to make sure if the AC craps out in the middle of the summer, the tenant's responsible for it, not you in a lot of cases too.
Right, right, right. Yeah, I mean those AC units are not cheap either, brother. We just paid one in our newest property. That was a $25,000 HVAC unit.
Yeah,
So
they're
yeah,
not cheap. They're not
yeah,
cheap at all. Been there, done that. But the great thing about it too is you've got a I mean, we all know things will happen, but having a 5-year lease versus say a 12-month lease or all of the chaos in the multifamily space right now. I
yeah,
mean, so much short-term financing and I mean, I've got a buddy who's in 19 or 20 different syndications and only one of them's paying him in a lot of cases. My next question is, are you getting a lot of folks that have invested in multifamily coming over to look to invest in something maybe a little bit more stable on the commercial real estate side besides the multifamily side?
yeah. I mean the multifamily space is it's definitely it's crumbling.
Yeah.
There's a lot of capital calls. There's a lot of pause distributions, and I've seen a lot of people lose more money because with the capital calls, you're effectively chasing bad money. You got to
Yeah.
spend more money to recoup, I don't know, 50% of it or something like that. So that's tough. But when we raise, it's a little bit more challenging for us because the education behind the non-residential stuff is pretty
It's
vast.
lacking. It's
Yeah.
lacking.
Yeah. And so a lot of people that are coming over from the multifamily space, they understand multifamily because that's pretty much the 90% of the razors that are out there, or the projects that are out there. They understand it. You know, you find a tenant, you lease it up for a year, you can increase rents by a couple $100. That's your value add. Very simple. But then once you get into the commercial space, whether it be industrial, office, or retail, there are different nuances with the three that you kind of have to educate your investors on for them to understand and be comfortable. Because as soon as they're confused, their answer is no, right? So
Yeah.
you have to be effectively a really good teacher to let them understand what the asset class is and how you effectively pull through with your business plan in order to get to that value add, right? But I wouldn't say our stuff is more stable. I don't buy like Starbucks or anything like that. Those are, five caps, even smaller at in some places. So I try to find all the value add stuff. So with more value add, there are more risks, right? But that's where your reward comes from. So, and that's why I like properties that are cash flowing from day one because it gives us that small safety net in order to still operate, have some CapEx or OpEx reserves, as well as being able to pay out our investors pref. Because my main priority when these guys come in is to return their money as soon as possible. I would hate for them to lose any money. And a lot of these raisers out there, they don't really see that. They raise X amount of dollars just so that they can make their fees on it, so that they can get rich, right? But I structure my raises so that all the investors can get their money back as soon as they can. And I don't get paid a dime until pretty much on the sale. Like, we'll charge asset management, acquisition, and dispo fees. But those act fees, they're pretty much put in escrow or they're going to wait till the sale. Management fees the same way, and the dispo fees the same way. I don't make a dime unless and a lot of times we do invest alongside our investors. So I'll make some money as the LP, and that's pretty much it until the sale.
Well, but you have that cushion in case something goes wrong or
Right.
non-payment to kind of cushion that blow to help you, build that time frame to work something out
Yeah.
in a lot of
Yeah. Yeah. Yeah.
cases, right? Now,
Yeah.
are your races what are your time frames for folks to be involved? Is it a little bit longer, I imagine, or is it 3 years typical, or 5 years? What do you see? And it
I,
may
I
vary.
I'm still doing 3 to 5 years. The last two deals that we took full cycle, the first one was 2.5 years, and the second one was a little bit less than 3.5 years. That gives us enough time because again, everything in commercial goes a lot slower. Lease up takes slower. Your value add plans take a little bit slower. So I try to get it as close to 3 years as I can. Luckily, nothing has gotten to 5 years yet, but I like to be conservative, and if I need the extra 2 years or year and a half or what so, I have that. Luckily, nothing's ever gone over 5 years either, so it gives me enough time to implement the plan as well as getting it to the finish line.
Sure. What are some of your biggest value adds that you do to properties to increase the values?
So your easiest ones are obviously lease up
Yeah.
and raising rents. And if you have a lot of people don't like seeing some of these leases being near their end term. So, if you look at a property that has a year's left with a lease, a lot of people shy away from that because it proposes some uncertainty of whether or not that tenant's going to renew or not. But on the flip side, you could see that as an opportunity to where you can renegotiate the lease at market terms and get another fresh 5 years out of it or 10 years, what have you. So those two are the simplest. When you look at operations too, there's an opportunity there. So, sometimes you have a pretty shitty property manager in there. They're not really doing what they say they're going to do with their tenants. They're just over-promising, under-delivering, or they're just non-responsive, and or maintenance requests are just not getting handled. Those are some things that you can kind of come in and revitalize the operations, make it a little bit more efficiently. And with leases, you can also change the leases. So if you see an opportunity where there are a lot of gross leases out there or even modified gross leases, you have the opportunity now to transition that to a net lease or triple net lease. Now all those expenses will be upon the tenant. So now, and the reason why people like the net leases or triple net leases is that your expenses, even if they fluctuate, even if it becomes volatile, all that falls upon your tenant. Whereas you, as the landlord owner, you have a little bit more predictability from base rents, right? So if your gross rents are, let's say, 500 grand a year, insurance goes up 200%, taxes go up a little bit, your CAM or maintenance costs due to another COVID or whatever jumps up, all those costs gets pushed onto your tenant and your NOI still remains roughly unchanged. So a lot less risk there from the landlord perspective. Now, the bigger pieces, the more challenging pieces, is when you get into a little bit more of the development space. So let's say you bought a property with a ton of land and you're able to build additional buildings on there, right? For hopefully less than $100 a square foot, or you can parcel out your land and sell it to another operator and or landowner. So, you know, my a friend of mine has roughly 12 acres that he's bought, and he's building small bay industrial properties. That's a roughly a value add, but in that same scenario, if you already had an existing building and you bought the land with the building, you can kind of do the same thing, build additional buildings there for additional revenue. We've created outlots in one of our commercial properties. The parking lot was huge, 400 something spaces. So we essentially cut out a small little piece, sold it to a coffee shop, and now they own that parcel. We sold the lot for $500,000. So that's another value add for our investors. Those are pretty much all the ways that we've done the value add structure from a commercial side.
That's really, really cool, Tan. Now, you're the host of Wonton Wealth, this
Yeah.
amazing podcast. And we'll put the link down there for you guys. What's been your biggest surprise with starting the podcast and having the podcast rocking and rolling?
At first I was like, I think the biggest challenge is finding guests, right? Because and the biggest surprise here is like, how do I differentiate myself against all these other badass hosts that are out there? They're asking phenomenal questions. Like, what if I ask the same questions? Like, why would people listen to mine, right? So the only difference that I had to do was pretty much bring my personality into it. I mean, if you guys didn't know, I cuss a lot, and I'm pretty informal. So I just kind of shoot the shit with people,
Yep.
and the other aspect of it, I think, is the editing and the back end stuff, right? I didn't know anything about running a podcast. I had no idea how to even start it. Like, how to, what do I record on? What kind of equipment do I need? What platforms do I go on? Is it going to cost more money? Things like that. So everything I had to pretty much learn on my own, Google, YouTube University, to learn everything there. And the editing piece, luckily I have a software that makes it a little bit easier. So I try to keep it honestly as raw as possible. I'm sure a lot of people spend a lot of money with VAs or whatever on changing the tracks and the videos and whatnot. I try to keep it as raw as possible. And if people like it, great. If they don't, well, I'm sorry.
Right.
But
No, but that I think you too also you focus on commercial
yeah,
stuff.
yeah,
There's a lot, and we don't need another generic based real estate podcast where it's all generic. You know what I mean? The fact that you're niche down, hey, if you're talking about commercial real estate, let's talk. If you're dealing residential fixed flips, not really a spot. There's plenty of other places for people to go that. So having that niche, I know for me being in the note space, that's helped me grow because you're literally getting listeners who really want are searching you out to find that valuable information. Whereas it's a lot of just guest after guest after guest,
and
not
that's
really.
that's really my goal too,
Yeah,
Scott. Talking to more people, it increases my education. I
yeah.
learn a little bit from them throughout every conversation, and on top of that, I'm just trying to help people that were like me in the past that didn't know shit, right? And
Mhm.
if they can learn those tidbits or whatever, that would help strengthen their education as well as shorten their learning curve. So that's
Mhm.
kind of my ultimate goal, really.
Sure, sure. Now, funny story is when I first was traveling the country on the Ron LeGrand circuit back and they get started, Ron would kill a small forest marketing to dentists and pharmacists. All right.
Wow.
Because unfortunately, dentists and pharmacists get to the point where they hate their job because they're doing the same thing, especially dentists. A lot of times, it's actually got the highest suicide rate amongst MDs, if you didn't know that, which is
I did
surprising.
not know that. Holy
Yeah.
shit.
But I would imagine to say that if you pulled a licensee list from every state, you'd probably raise enough money because you've got a great message. You can speak pharmaceutical or pharmacist language, you know what I mean?
Yeah.
And you're doing something that's doing really, really well where a lot of people want to get into, they just don't know where they got to go or how to do it. And you're doing that by walking the walk and also talking the talk.
Yes,
Uh,
sir.
I want to say thank you for getting. What's the best way though for our audience to connect with you, to see what you're doing, to keep up with your, or hey, I want to invest in commercial stuff or find out more.
Yeah, yeah. I'm pretty active on social media. Facebook, I don't really touch much. If you want to go to LinkedIn and just search my name, TANH is the first name, last name TRUONG. Same thing on Instagram. Pretty active there. I have a website called protonprofits.com. You can find out a little bit more about me there, just kind of the general background and what like some new shit that's going on or whatever. Again, podcast is called Wonton Wealth. It kind of takes the book and puts it in audio form, some of the major overview components. If you're not a reader, I think that'll be a great place to start. Yeah, and again, I have a book called Value Over Volume. If you guys want to check that out, let me know how it is, good or bad, I don't care.
Right, exactly. Well, we'll make sure to put the link to the book and then also Proton as well there for folks who connect with you directly on that stuff there. Tan, this has been really valuable, man. We got to have you back on a second time again to talk about some more stuff in the market. As markets change here in the next year, what do you say?
I would love to. I always have a blast talking to you, brother. We have so much fun and learn a little bit of a couple nuggets here and there, so I will be 100% down.
Awesome. Sounds great. All right, guys. Well, that is going to wrap it up for this episode of the Note Closure. Make sure you connect with Tan. Get his book. One of the most valuable tools to take advantage of where the market's going is the education side and the knowledge base. And I've learned some stuff here. I'm looking forward to more stuff on the side from that comes from the book and stuff like that, because I think that's the biggest opportunity is that small balance commercial space and location, location, location. If you're there local or you got a few markets you're familiar with, definitely take the opportunity to do it, because that's where the opportunities lie, is where those most people won't go. And that's where you'll find some stuff. So go out, take some action, everybody, and we'll see you at the top. Bye. Hey, real estate investors. So you want to dive into the world of note investing, but don't currently have the funds to sign up for an expensive class or a workshop or one-on-one coaching. Well, then you definitely want to check out the biggest bang for your buck in the note world, and that's our WCN membership. It get you an all-you-can-learn access to our class workshop replays, tapes, weekly coaching calls. For $97 a month, it's the biggest bang of the note industry, because you get access weekly with me. You can book one-on-one phone calls with me. As we get different tapes in, we'll share them with our members after our one-on-one coaching students get access to us. We share a variety of tools, like I said, replays to the previous workshop, special discount codes to other events that you can take advantage of to help you get more bang out of your dollar every month. We've been investing in notes for over 20 years, and one of my biggest passions is helping note investors, big and small, get started buying notes. Yes, I got started years ago with no money, no savings, and no list. And I love helping people close on their first deal, get their first private funding partner to help them fund more deals and help them both make above average returns. If you're looking for somebody to help you take your note investing from 0 to 60 and want to get started, my WCN membership is a great place to get started. Like I said, we upload lists to it, video training, coaching calls for $97 a month. What can go wrong? The only thing we ask is you hang around for 6 months, and then if you don't like it, you can cancel. But check it out at noteumbrella.com. That's noteumbrella.com. That's our WCN membership. Get looking at assets today. Start putting your fingers on the trigger to pull the trigger on some note deals here before too long. Yes, anybody can buy notes. I don't care your age, your savings, what race, color, whatever it is. Note investing is all about what action you take, and the first action you should take is signing up for our monthly membership at $97 a month. That's noteumbrella.com. You can also access it by going to weclosenotes.com and checking on the monthly membership. But we are here to help you. Scott Carson, the Note Guy. We look forward to seeing you at the top.